Hey guys, welcome back to this channel. In this video I'm gonna talk about, let's say, principal and interest or interest only, fixed or variable rate. So these are based on my perspective and my own experience. This is what my wife and I did on most of our investment property. Actually, I think it's all of it now. However, I'm going to talk about one particular one. So I guess it's confusing because when it comes to loan alone, first of all, you got to figure out the price of the property, and then you got to get a deposit. Now the deposit is reflect on let's say percentage, yeah, it's percentage on the price. So on this particular one I'm going to talk about, we put down 5% deposit on the property. Now I'm not sure if I've actually mentioned it before, but if you can, obviously, if you're starting investing, let's say, I would put down 20% deposit purely because of the lender's mortgage insurance going to get kicked in. It's pretty much an insurance for the bank, it's not for you. But I did not know that. All I want was actually just getting onto the property. But if I started again, then I would do at least about 20% deposit. So one, it minimizes extra fees involved, let's say. But never mind that. So this is what happened based on my 5% deposit property. And I still managed to get a passive income from it. So I guess some people out there would have chosen variable interest rate. I've seen a few people that I've been working with where they actually are paying interest rate variable because you're banking that it's going to be a bit lower throughout the year or so. But it fluctuates. What I don't like about variable interest rate is that it fluctuates week in, week out, month in, month out. It's not the same. Sometimes you can go, it varies. Sometimes it's only a couple of dollars, sometimes it can be $100 difference. So I don't like that. I don't like the fact that tomorrow a news happen or next month certain things happen and then the interest rate is slightly a little bit more higher. That means your repayments a little bit more higher, and then the next month it would be a little bit lower because certain things happen. So I don't like that fluctuability, and because my income, it doesn't really fluctuate as well. So that's why I don't like a variable interest rate. I like a fixed. I like a fixed interest rate because I know how much money comes in, money goes out every month. Now each bank will be a bit different. I would suggest, if you already have an investment property and if you are on variable interest rate, have a chat with your bank. Each lender is a bit different. My example on this video would be by calling the bank that I'm with and fixing it. They're giving us 3 different options, either 1 year, 2 years, as well as 5 years. How long you want to fix the interest rate for. And it worked out to be that the 2-year mark is actually the cheapest interest rate that I can get a hold of. So what that means is, let's say if it was say 4%, for example, and if I were to fix it by about 1 year, it goes down to 3.1. But if I'm doing it through 5 years, it will be about 3 point something rather. But it works out to be the middle ground. The 2 years is actually the cheapest amount, the cheapest interest rate. So each bank is a bit different, and there are fees involved as well by making it fixed rate. It all depending on your lender as well. So the reason why I fixed it for 2 years because it's the cheapest, and on top of that, because I know that my let's say my tenant it's actually gonna pay me at a fixed price. Like their rent is gonna be the same amount, so I want to have that certainties. My tenant is paying me a lot more than a typical market rent, because I actually use a strategy called seller finance or vendor financing. So because of that, I know how much every month I'll be getting, every month how much I'm have to paying out to the lender. So as a whole, like, we did variable at one stage, but due to the uncertainty, I don't kind of like that. And because my I guess my buyer or my tenant, the person is taking over my mortgage, they want a certainty for a certain length of time. Due to that, I was able to fix at a rate, the cheapest rate it would be, and it's benefits for both. One, it benefits me, I know how much coming in, and two, it benefits them because they know how much, and my buyer as well, or my tenant in that instance, how much they're going to be paying out every week, every month. So I hope that makes sense. So, and it all comes down to also what type of strategy that you're actually doing. Some people preferred interest-only loan, because like interest-only loan is pretty much the premium product out there, the most expensive product, I say, because you're not actually paying any of the principal on that particular loan. I don't like paying interest-only loan, but some people do. So some people is banking that tomorrow is gonna the price of the property is gonna go up, double and whatnot. But I've seen the worst part of that, where property is actually gone backwards. So yeah, interest-only loan, I guess it's good if you're doing a short term. From my perspective, from my point of view anyway, it might be a little bit different for some. And what I don't like about interest-only loan, like some of them actually give you, some lenders give you like a time frame, like 1 year, 2 years, or 5 years before you hit a principal and interest repayment. And if you're not really in a ballpark, like on track on that, when it hits a P&I, principal and interest repayment, it's a lot higher than what it is currently. So for that mean, instead of a 30-year loan that you've been paying principal and interest, you'll be paying based on 25-year loan, principal and interest. And some investors get caught out, like, oh my god, I forgot that it's actually P&I now, and they can't afford it, and they have to sell the property at a loss, or to get out from a sticky situation, let's say. I, on the other hand, I fixed it. I paid principal and interest straight away. If I were to do it again, I would do P&I straight away, in the condition that you have the same strategy as what I have, because and I look at it as well, like, should you fix it or should you not fix it? It all depending on your circumstances. Like for me, I like to fix the property, or the fixed repayment is because, not fixing the property, fixed repayment system, because I know the figure every month it will be the same for the next 2 years. In my case, let's say, might be a bit different from you. If you're doing a 12 months, then you're gonna do it for 12 months in the same repayment system or so. The other thing would be that I did is the financial institute is not gonna actually tell you like at the end of, some of them do, like we take a notice on the notification, I guess, on the letters. They're not gonna tell you that, oh, by the way, here's a better rate, you should go into this. You actually have to go to them. You're actually gonna the one that have to approach them at the end of the expiry time, let's say, like a month or two beforehand. I would suggest to actually give them a call again, and ask them, or like more like a couple of days before that, like in a week before that, give them a call again and ask them what's the best rate at that particular time frame. I've done mine twice so far, because I've held my property, what's that, at least about 4 or 5 years or something. So every 2 years, the first 2 years I fixed it, and then after that I called up again, and then I did the same thing again. It turned out, and all because I want to know the certainties. So some people prefer the other way around, but this is based on my personal experience. I like the certainty that I'll be paying X amount of dollars for my mortgage every month. So it might be a bit different to you guys. So yeah, and I think that's about it. Principal and interest, I choose principal interest or interest only, so I choose principal and interest. And variable and a fixed rate, I choose a fixed rate. So yeah, I'll talk to you guys in the next video. Hopefully this is very helpful for you guys. Talk to you guys later. Bye.